Okay, in this example, we're going to look at marginal tax rate and standard deductions. So here's a table that shows tax rates, okay, and standard deductions. There are four ways you can file. You can be single, which means you're unmarried, divorced, or legally separated. You can be married filing separately. You can be married filing jointly, which means you file together, or you can be filing as the head of the household. That means you're unmarried, but you're paying more than half of the cost to support a child or a parent. Okay, this includes the tax rate. And for each category, this is your standard deduction. Okay, so you would have to have more deductions than this when you itemize for it to be worth your while. Otherwise, people just claim the standard. Now, if you look at this, like for a single person, we're going to do this in the next example. Up to $9,950, they're going to pay a 10% tax rate. Anything above that, up to $40,525, they're going to pay 12% tax rate. From $40,526 to $86,375, they're going to pay 22%, and so on. The more you make, the higher that tax rate. Okay, so let's look at an example. It says calculate the federal income tax owed by a person filing a return as single, whose gross income adjustments, deductions, and credits are given. Use the table rates from the table. Okay, so this person has a gross income of $67,000. They have an adjustment of $9,000 made to a tax-deferred IRA. So you guys know that we're going to do an adjusted gross income in a second. We're going to subtract that out. Let's look at their deductions. $7,500 mortgage interest, $3,200 property taxes, $5,450 charitable donations, and $1,500 medical expenses not covered by insurance. There's also a tax credit of $500. Now, one thing about those medical expenses, you guys, remember it has to be 7.5% of their gross income. And if you multiply that by the 0.075, we're not going to be able to count those. It's not high enough. We'd have to have over 4,000. So, all right, let's go back and look at the table, by the way. For this one, the standard deduction for a single person is $12,550. Okay, so let's look and see what our adjusted income is going to be. We're going to take his $67,000, subtract that money that was put in an IRA, I believe is what it said. Let's see. Yes. And then we're going to end up with an adjusted gross income of $58,000. Now let's look at deductions. See what the taxable income is. Okay, so we're going to take his $58,000 minus the deduction to get taxable income. We can do the mortgage interest, the property taxes, the charitable donations. See, they have this marked out because that wasn't enough money for medical expenses. We couldn't deduct it. Now all of these add up to $16,150. Now remember, the standard deduction for this person was $12,550, so they are better off itemizing. Okay, so we're going to use that $16,150. So you take $58,000 minus $16,150, and our taxable income is going to be $41,850. So let's go back to the chart a minute. $41,850 puts them in here. See where they're going to be right in there? So for the first $9,950, they're going to pay 10%. The money between this, they're going to pay 12%. And the money above $40,525, that money they're going to pay 22% on. So let's see how we would figure that. I believe it's on the next slide. Okay, so this talks about the 22% tax brackets on the money that is above that $40,526. Let's look at the next slide where they have it all worked out. So 10% on that first amount. Then you take that $40,525 minus the $9,950, okay? And you're going to pay 12% on that amount. Then you take, and remember I'm getting these numbers from the table. Let me go back to the table. Oops, wrong direction. See, we're looking at these numbers right here, okay? So lastly, we're going to take all the money that's above $40,525, and we're going to multiply that by 22%. So we take their first amount. In between there, at 12%, they have $30,575 they made. And then they had $1,325 that's going to be taxed at that higher rate because they were over that $40,525. Okay, so when you multiply here, you get 955. Here you get 3,669. And when you multiply these, you get $291.50. And that adds up to $4,915.50. Now, don't forget they also had that tax credit. So we get to subtract the tax credit. And then this would be their federal income tax.